the tax on your Social Security benefits could be zero, or that marginal tax rate could be almost double what you expect it to be. Let's understand how Social Security tax works and how it affects your retirement. Now, most everyone I talk to isn't prepared for how Social Security taxes affect their retirement. They don't bother withholding their taxes from their Social Security when they file, and quite often this can create a big tax bill surprise come tax time. I helped some clients of mine, Mike and Lisa, file for Social Security a few years back. I told them to withhold the taxes out of their Social Security. Actually, it was just Lisa who filed, and they figured since it was just one benefit, they almost always got a refund beforehand. It probably wouldn't be a big deal. Well, next April rolls around, I'm sitting at my desk taking care of things, my phone rings, Mike's on the phone, and he says, I just got my taxes from the accountant. How come I owe $3,200 in taxes? I never owe taxes. What went wrong? Well, I say bring in the tax return and the documents. Let's look it through, figure it out. Maybe it's a mistake. I meet with Mike and Lisa the next day. We have all their documents spread out on my conference room table, and I'm going through them when I say, I found it. It looks like the accountant forgot to put your Social Security tax withholding on your taxes. Let's find out how much you already paid. Let's get that put in there right away in the right spot. Well, that's when Mike and Lisa look at each other, look at me, and then Lisa says, we've always had a refund. It was just my benefit. I know you said we should set up the withholding, but I don't think it would matter. I guess I was wrong. So I immediately went to the Social Security website, printed off the tax withholding form. They filled it out, mailed it in, started their Social Security tax withholding, and when we reviewed their tax return the next year, they got a refund. Now, filing for Social Security is going to drastically change your tax situation. And if you just file for Social Security, like Mike and Lisa, you need to learn how Social Security taxes work so you don't get that same sort of tax bill surprise. And if you haven't filed yet, you need to learn how Social Security taxes work so you can plan ahead and hopefully lower your lifetime tax bill. The first thing you need to learn with Social Security taxes is something called provisional income. Like I said, Social Security might be zero, or it might be almost double your regular taxation. Let's look at this provisional income formula and how it goes on your tax return. With Social Security, before you figure out how much is going to be taxable, we've got to take another step ahead of time. It's that provisional income. So provisional income, you take 1/2 your Social Security, then you add everything else, including everything else that was tax-free, right? You might have had municipal bond interest, something that was tax-free, not on your tax return anyways, but it goes into that provisional income number. Let me just give you an example. Imagine your Social Security is $20,000, everything else is $20,000, and then everything that's tax-free, maybe that's $5,000. Well, with Social Security at $20,000, half that is 10, plus 20, plus 5, we now have a provisional income number of 35. Now, here's why all this stuff could be a big surprise. Because depending on where this number falls in, either 0%, 50%, or up to 85% of your Social Security could become taxable. So you've got this provisional income number. If you file an individual tax form, right, you file as an individual on your taxes, if that number is between 0 to 25, there is no taxes on that. Wonderful. Between 25 and 34, 50% of that money that shows up in there would become taxable. And then anything above 34 plus, up to 85% of that amount shows up as taxable on your tax form. Now, that's not the tax. That's just what shows up as taxable from Social Security on your tax return. Now, if you file a joint return, they give you a little bit of a different number there. Between 0 and 32, that's where none of the Social Security, if this provisional income shows up here, none of the Social Security will end up showing up on your tax form. 32 to 44 is the number where that provisional income, this is not your taxable income, your AGI, this is that provisional income number that you've calculated. Between 32 and 44, the 50% of it that shows up there is the amount of Social Security that gets on your tax form. And anything above $44,000 for the joint individuals, that could be 85% that shows up on your tax form. Now let's go into some real deep dives on how this could really affect you and make that tax cost to you much higher than you expected. You've got $60,000 of income, $30,000 from a pension, $30,000 from Social Security, and roughly $30,000 is that standard deduction. Let's first figure out the provisional income. So you've got $30,000 from Social Security, but 1/2 of that is $15,000. You've got $30,000 from the pension and nothing else, 0 in the tax-free area. Well, half of Social Security is $15,000. You get everything else is $30,000. That equals $45,000. That is now your provisional income. Well, your joint couple, you're filing. Let's see where that falls in. $45,000 is into this area where 85% of your Social Security could be taxable. Thankfully, it's not just instantly like you hop over by a penny and you're out of luck. You have 85% taxable. The way it looks at it says you fall into here, 45. This part, no taxable. This part, there's 12,000 of your Social Security that falls into there. Well, half of 12 is 6. Then you get into, there's only $1,000 in this part of it. 85% of the thousands, $850. So that's not too bad. But I'm just going to make it 1,000 for this example, make my math easier. So only 7,000 for them, for you, if this is your situation, only 7,000 is taxable of your Social Security. So you would imagine your pension is taxable. You'd imagine then your Social Security now is only 7,000 is taxable. 37 is your adjusted gross income. Very much simplifying all this. You take away that standard deduction of 30, again rounding up for a standard deduction, and only $7,000 becomes taxable. Not terribly too bad. If you're in the 10% area, roughly speaking, that's only $700 of taxes on $60,000. Not bad at all. But what happens when you hit your required minimum distribution age? If you have $500,000 in your IRA, that's roughly $20,000 of required minimum distributions. None of this changed here other than you just had to add on $20,000 for your required minimum distribution. Now you have $20,000 more of taxable. You'd expect, okay, $20,000 more came out, $20,000 more becomes taxable. Let's see where this plugs in now for the new provisional income. You still have $30,000 of Social Security. Half of that is $15,000. You still have $30,000 of your pension, but now you also have the $20,000 of your required minimum distribution. So 15 plus 20, 15 plus 30 from your pension, plus 20 from the required minimum. Now we're up to 65. Right? This is a much bigger number. Your provisional income only changed by 20,000 because you had 20,000 more income. Let's see how this really plugs in. We saw before how you only had 7,000 of your Social Security taxable. Well, now we're at 65. Where do we go from here? Well, you still have 12,000 of it showing up in that area. Still only 6 of your Social Security is taxable. You've got, well, got to get to 65. We're at 44. That's 21,000 in this area. That's 85% taxable. 85% of 21,000 is 17,850. I'm going to round it up to 18. Just a little bit easier math. So of your 30,000 of Social Security, you now have 24,000 of taxable. So you've got, same before, you had the pension. We've got to add on that 20,000 now of required minimum distribution. We've got to change the amount of Social Security that's taxable. Now we're at 24 and that number. So you added on 20,000 of your required minimum distribution. But now your taxable amount, that AGI, 20 plus 30 is 50 plus 24. Basically, you just doubled here. You went to an AGI of 74, right? When you add that all up, minus your 30,000 standard deduction, here we are at about 44. That's taxable. Now you have 37,000 more taxable income. You're now in the 12% tax bracket. Well, you'd expect with more income. Roughly speaking, you'd expect 20,000 more income, 12% tax bracket. That's only $2,400 in taxes. So here's your expectation, $2,400. Well, in reality, you had $37,000 more taxable income. At 12%, that's $4,400. So your reality is more $4,400. So all you did was you took out $20,000 from your required minimum, and the tax difference was $4,400. You're in the 12% tax bracket, and that cost to you, the difference, $2,200 of the difference on there, that's a much bigger difference than you would have expected. You're paying more in taxes, almost double what you would have expected. And you're probably thinking, this isn't fair. This is ridiculous. And you're right. I think that's the situation. But thankfully, you know about this now, which gives you two things to help combat this Social Security tax surprise, when some people call the Social Security tax torpedo. If you're filing for Social Security or you're already on Social Security, I suggest you do tax withholding using the form W4V. You download it from the Social Security website, you fill it out, you mail it to your local Social Security office. You would probably want to do your current tax bracket at the minimum, but because of this Social Security tax torpedo, you might want to bump it up to the next tax bracket for the withholding. The problem is you can only withhold 4 digits, 4 different areas for the withholding. 7%, 10%, 12%, 22%. So you have to work within that framework. If you haven't filed yet for Social Security, I want you to consider two things. First, figure out what your Social Security tax situation might look like ahead of time. You don't want to get this extra tax cost surprise. We like to do that ahead of time with our clients, where we're projecting out what their Social Security tax situation might look like before they're even on Social Security. So if your financial advisor or tax preparer isn't doing that, perhaps you should look for a new advisor. Second, now that you know how this tax situation is looking like, if you think you can pay taxes today at a lower rate compared to what it might be in the future at a higher rate, that's usually a good idea to do so. You might find that you're currently in the 12% tax bracket, and your Social Security tax torpedo is likely to cost you more, cost you perhaps 22% on that amount that you're taking out from required minimums especially. Then you might consider looking at a Roth conversion before you file for Social Security. Now, don't do that conversion until you plan it out. Make sure you're paying taxes at a rate lower than you expect to pay in the future, and account for things that might surprise you that aren't exactly tax form related. There's an extra cost for Medicare if you hop over and pay too much, or have too much rather, in taxable income. If your income's too high, then Medicare would actually cost you more. Or if your income grows and you're below 65, you might lose some of those affordable health care subsidies. Your retirement plan might be missing a plan for your Social Security taxation. Go ahead, plan it out for your taxation by following the steps you learned in today's video. And check out my next video, Is Your Retirement Plan Flawed? Hi, I'm Jeremy Keil, owner of Keil Financial Partners. And if you're interested in seeing how we help our clients get more income, pay less in taxes, and avoid big retirement mistakes, make sure to go to keilfp.com. That's KEILFP.com.